Good afternoon and welcome everyone. Thank you very much for attending RSM's webinar on redundancy, what you need to know. I'll just remind you that today's webinar is being recorded and will be available for viewing after the webinar with slides and materials sent to you. Throughout the webinar, should you wish to ask us a question, your microphones will be muted, so please send us a message via the Q&A box down below. Also, throughout the webinar, we will be collating all questions that you have asked and we'll endeavour to get through most of them throughout the Q&A. Please note, lastly, we do value your feedback. So at the end of this presentation, we would value just a short survey if you could please complete. Before we commence, I will need to briefly outline our general disclaimer warning to let you know that this presentation is being presented to you by RSM Financial Services, Australian Financial Services Licence Number 238282. This presentation contains general advice and is prepared without taking into account your individual objectives or needs. So if you are after specific personal advice, please do not hesitate to get in contact with us at the end of our contact form. My name is Ross Trimboli and I'm a paraplanner at RSM Financial Services Australia. I'm located here at the Canberra office. Today I'm joined by certified financial planners Lindsay Walker and Chris Oates. They have extensive experience in the industry supporting their clients who have faced the uncertainty of a redundancy, guiding them through what it means for their family, their lifestyle, and how they can be guided through solutions and outcomes to better meet their needs and objectives. For those who have not heard of RSM Financial Services, we are our own company that operates under our own Australian Financial Service licence, made up of around 40 advisors around the country. RSM and its investment committee provides holistic financial planning advice. So if we have a look at some of our offerings, we have some savings and investment advice, personal insurance and protection, portfolio construction management, pre-retirement planning and post-retirement planning, estate and aged care planning, and financial consulting. So if you think you or a friend might need to talk to RSM about any of the above areas you feel you might be relevant to your circumstances, please get in touch with us through our online contact form. So we do have that at the very end of our slide. So if you cannot access the link, please send us a message and we'll endeavour to see how we can help you get that sorted. So if we now move on to the next slide, as part of today's agenda, we'll be looking at three main areas to focus on when it comes to redundancy. Firstly, Lindsay will be covering off on the different types of redundancies that can be paid to individuals, as well as their different components. We'll later find that no redundancy is quite the same for everyone. Lindsay will then further go on to discuss the taxation of redundancy and making sure that you understand exactly what benefit components are made up in your redundancy. Lastly, Chris will be covering off on what you need to think about when accepting a redundancy and how it is important to consider your income and lifestyle, debt, investment and superannuation needs. So if we now move on and look at what is a redundancy in its simplest form, by Fair Work, as they describe, a redundancy occurs when an employer either decides they no longer need an employee's job to be done by anyone, or the employer becomes insolvent or bankrupt and terminates their employment. So as a result, you may be wondering how a redundancy may come about in your employment. Termination of employment can happen due to many reasons such as redundancy, resignation or retirement. The reasons for being made redundant can be due to the job itself, not the employee becoming redundant, such as the organisation wants to reduce the workforce count by removing jobs, a position is no longer viable to the business model or the organisational structure, there is a slowdown due to lower sales or production closes down. When the business introduces new technology, that's also another factor. Businesses might also relocate and their business structure might change. There could be the possibility of a merger or a takeover occurring in the organisation. So if we now look at the current economic climate, here's a snapshot that we've been provided from the Reserve Bank of Australia. We've seen statistics come out and shown that economic growth is slowing down. Just this morning, Australia has entered into recession for the first time in 30 years. As a result, we've seen the unemployment rate jump to about 7.5%, some of the highest levels since the late 90s. With mortgage repayment pauses recently introduced by some of the major lenders, we've seen about $195 billion in mortgages deferred. Household debt is high. It has increased to 187% of assets. Yesterday, JobKeeper was announced that it will become extended to the end of March 2021. The household savings rate, if we just go back a moment, whilst it has increased over time, it still remains relatively low at about 5.5%. So it shows that many Australians are still not saving enough for a rainy day. So these are some interesting figures in light of the current economic climate that we need to consider when we're faced with the redundancy. That is now why I will pass on to Lindsay, who will further outline the different types of redundancies, their benefit components, and their tax treatment. Thank you, Lindsay.
Thanks, Ross. So we just wanted to set the scene before moving on to the key aspects of redundancy. So thanks, Ross. We might get right into it. So the redundancy, what is included in redundancy? Generally, you'll have a lump sum payment based on your years of service with your employer. Quite often there's a payment in lieu of service in addition to the number of years. Also, you will look at any unused annual leave and long service leave. For some, you may also have an extra payment or a golden handshake, let's call it. All of these have limits, and then you may also have what's called an employment termination payment. So let's just look at each of these and then how they might be taxed. So a genuine redundancy is if you're under age 67 and if your employer has the workplace agreement, or it may have applied to the ATO, but a genuine redundancy is where you're under age 67 and it includes the base amount, as I mentioned, for each year of service. Compare that to the employment termination payment, as I mentioned. There are tax treatment if you're under age 67 or if over age 67. So if you're under age 67, quite a good portion of that may be tax-free. It's treated differently if you're over 67. And of course, any leave that you've accrued, it is taxed separately. It's not taxed the same as a redundancy, but we just wanted to cover off on leave, your annual leave and your long service leave. And how that's earned, it can vary from state to state. So, you know, if you're in different states, you may have different things in your workplace agreement. So just looking at the next slide, you know, as Ross mentioned, you know, it's really not about you, it's the job that needed to be done. The employer has either followed the requirements, you know, in your award or an enterprise agreement. There is another one which is an early retirement, but they need to apply to the tax office. So as long as the employer follows the procedures and meets those conditions, then some of the payments will be considered a genuine redundancy. So the good news, or sadly, the person may be made redundant, but the good news is there's a significant tax-free component. So in a genuine redundancy, there's really a $10,900 plus about $5,500 for every completed year of service. So whatever you're paid, you'll end up with a good portion of the payment that should be tax-free if it's a genuine redundancy. And as I mentioned, if you're lucky enough to get a significant payout, the tax office does have various limits, and we'll cover that. But anything above the tax-free component is what's called that employment termination payment. And as I mentioned, accrued annual leave and long service leave, they are taxed separately, but you'll see in a moment they do attract a concessional tax where you are being made redundant. So let's just look at the next slide. Get into the tax components. So again, it also occurs if you reach your normal retirement age on the day of dismissal. If you are not genuinely made redundant, that means you may have just resigned or left voluntarily. So these ones don't form part of that tax-free. So as I mentioned there's no tax-free component. So if that was the case, then it's really all part of that employment termination payment. Now, it is a fairly high limit. Everything's relative, I know, but you still get concessional tax up to $215,000. And in some more complex circumstances, there is another cap called an income cap. We decided not to cover that today. And finally, the annual leave and long service leave in this case would be taxed as normal income. So you don't attract the concessional tax because in this case, it's not a genuine redundancy. So let's just look at a table to summarise that. If you're under preservation age, then up to that $215,000, you would attract 30% tax. If you're above preservation age, the tax is less, it's only 15%. And if you're way above that $215,000, then you would attract 45% for that amount that's above the cap. So let's have a look at a couple of examples. Probably the easiest way to just get our head around how the tax treatment occurs. So here we have Kevin, he's 56 years old. In this case, he's been with the Commonwealth Government, say, for the past 24 years, and his position is no longer retired. So he's been offered a voluntary redundancy from the public sector. So looking at his tax treatment, so the 24 years, his annual salary is about 80,000. In this case, the redundancy payment is 70, and he's lucky enough, he gets a payment in lieu of about 8,000. And his leave payments are made up of 15,000. So all in all, he's got $93,000 to consider. However, the redundancy payment is only the $78,000. The good news for Kevin is that with the number of years, the 24 years, technically he could have up to $142,000 that would be tax-free. So in this case, his redundancy payment is all tax-free, and there is no amount that's going to attract that higher tax. So then let's just look at the annual leave. Because he's coming out under that redundancy, it attracts the 30% concessional tax rate on the leave. So it doesn't go into his normal tax return. The limit would be 30%. So only $4,500 tax there. So after all of those components, Kevin would walk away with $88,500. So let's just have a look at another scenario. In this case, we have Sharon, who's around 40 years old. She told me that was her age. She's been with her employer in the private sector this time for about 15 years. And really the business is struggling, so it's her position again that is surplus, and she's been offered a redundancy as well. So let's look at an example for Sharon. So the 15 years, the annual salary is $130,000. In this case, the redundancy payment is about $120,000, plus she gets that payment in lieu. And then a small amount of leave is left over, so about $10,000 leave. So in this case, Sharon has $143,000 in her package. So let's just have a quick look at the tax treatment for Sharon. So again, the redundancy payment is $133,000. But with her, shorter period of service, you can see in this case that her tax-free amount is only going to be $93,400. So for Sharon, she now will attract some tax. So not all of her money is going to be tax-free. So you can see that $39,500 attracts a 30% tax. So she will lose $11,800 on that portion that's called the employment termination payment. Looking at the accrued leave, she is lucky it does attract the 30% concessional tax again. So all in all, out of the 133, she walks away with $128,000 after tax. So I just wanted to show you a couple of examples. Although redundancy may be scary for many, the tax treatment can be quite generous for most individuals. As I mentioned, there are higher caps. So we just wanted to give you those two scenarios just to show you how the tax works. So planning for your redundancy, I might pass over to Chris now, who will take us through, those components. So over to you, Chris.
Excellent. Thanks, Lindsay. So Lindsay's just gone through with us basically how your redundancy is made up, and it is important to check and make sure that you understand what you are receiving. Then the next step is really to, well, how do you plan for the redundancy, and well, what do you do with the money? How does it affect you? So when we do this, we break it down into four main areas. So the first one is we all need to make sure that we keep meeting our income and our lifestyle needs. A lot of us have debt, so how do we manage that ongoing? And then investing for income and growth. So that might be that you find work quickly, or you may need to actually replace your income streams. And then the last part is superannuation. Everything seems to impact our superannuation, so we'll look at how that works together. So if we start off on the meeting income and lifestyle needs, everybody's situation really is different. So it is important to plan and understand how it affects the household budget. So how much are you actually spending? What do you need to keep buying the groceries, putting fuel in the car, and those sorts of things? Then we've also got education and childcare costs. So kids, they're the future of the country. So we want to make sure that we can keep sending them to school, getting them the support that they need. And then also, we all have insurances. So it might be your car insurance. It might be your home and contents insurance. It might be life insurance. So they all do add into our expenses. This is when we are starting to think about, well, times might be a little bit tough. It's a good time to actually review what you are paying. So if you can reduce your premiums on those, if there's ways to do that, you also look at the level of cover that you do have, then that might be a way that you can actually reduce some of the stress that you've got on that household budget, so that money's there, more money is there to pay for groceries and the likes. When we're sort of thinking about setting that household budget and how much money you have, the first thing to look at is what actually goes into your bank account each pay. So a lot of us, we know the figure that we earn each year or what our hourly rate is. But once you take out tax, and you might take out a few work expenses, you might be paying some money into your super, what is that actual amount that goes into your bank account? And so how do you replace that? Because that's really what we're funding all of our living costs off. So then the question comes, where Lindsay went through how much can potentially be paid out, how long can the redundancy last you? So if you've got the money, how much money would normally be going into the bank account, whether it's each fortnight, month, week, how long can you sustain your normal lifestyle with that redundancy payment? And then the last thing as well is, do you have a backup fund? As Ross said, the household savings rate is quite low. So a lot of people don't have money set aside for a rainy day. So it might be with your redundancy that you might actually want to keep some money there on the side, and so that the car breaks down, the washing machine blows up, you've actually got that money there that you can fund those expenses without having the stress of, wait, times are tough, I don't have an income, how am I going to afford this? If you've already planned for that to start with, then that can actually really help you out. So if we then start looking at the debt, as I said, a lot of us have debt. A lot of us have mortgages. If you don't have a mortgage and you paid it off, well done. But we do have, it's not uncommon either for people to have a credit card or personal debt. So that can be a car loan. You might be doing renovations to the house. You can have all of those debts and different repayments coming out of the bank account. So you might have 2, 3, 4 different payments coming out. So it'd be the time to talk to the bank or talk to a mortgage broker or someone and think about consolidating them so they're all into one loan. So if you're using your mortgage, for example, it's probably got a lower interest rate than your credit card or a personal car loan. So if you can actually reduce the interest that you're paying, you'll also save a lot of money on the interest charges. Also, it makes things a lot easier where you'll have one payment coming out of your bank account. rather than 3 or 4. So if you've only got that one payment, you know what's there, you know, you can see it come out. You don't start to worry, what other payments do I have? So then it does actually reduce the stress that you have as well. Also, if you're not earning that income, the big question is, how long can you continue to pay your mortgage and meet those repayments? So if you've worked out into your household budget how long your redundancy will let you continue with your expenses, did you include your mortgage? So that's a big part of most of our expenditure. So just think about how long that can be covered for. If you do get to a point where you can't make those mortgage repayments, the first step is, I would actually think about talking to your bank. So banks in general, they don't want you to fail on your loan. They're there, the longer you have the loan, they're making more money out of the interest you're paying them. So they will be there, they will want to help you where they can. Different things that you can do is you can defer repayments. As Ross said earlier, a lot of people have done that at the moment. Now things are stressed. So do talk to them about your options. They might let you pause the repayments, or they might let you defer it. If you do defer those repayments, they may want you to pay them back later, so you keep that in mind as well. Then the other part is change the loan term. So basically what we mean by this is, you might have had a 25, 30-year loan and you're 10, 15 years into that. So start to think about whether the bank would let you extend those loan terms, so that you might be able to extend that and take another 25 years. So then that can reduce your repayments while times are tough. If you do that, then I would actually probably encourage you that once you do find work, that you then look at, can you increase your repayments so that you're not paying a lot more interest over the extended period of the loan. Also, we might have redraw facilities. You might have been doing very well and paying extra money into your mortgage. So that can actually leave us with a bit of a buffer. So if we get to a point where you can't meet those repayments, you might actually be able to use some of that buffer for a short period meet those repayments. So that can actually definitely very much help. And the last one is, interest rates are the lowest they've ever been. If you haven't reviewed your loan in the last couple of years, definitely talk to your bank about the interest rate that you are paying. That can really help, one, reduce payments if you can, but two, also it might actually mean that if you are able to keep your repayments the same, you'll pay your loan off quicker by not paying as much interest. So yeah, so there are quite a few different things that you can do to make sure that you can keep paying that mortgage. As I said, banks don't want you to default on the loan. They will work with you. And then review your full debt situation. See if you can actually consolidate your debts, and then think about, well, how long can you pay your mortgage for? So if we look at, so that's sort of covering off on the debt side of it. If we look at, well, what can you actually do? You receive the lump sum money into your bank account. So what then, how does it impact on your superannuation? So there's a couple of things that you can look at. So there might be, say, early retirement. If you were sort of thinking about retiring and you were coming up to it, you might have thought, well, a couple of years away, maybe I do retire now and just bring that forward. The key thing to that is, can you access your super benefits now, or do you need to wait, or should you wait? So that will come into it as well. Do you need that redundancy then to get you through a couple of years to cover that time frame? Or, I know I'm based here in Canberra, we've got the Commonwealth public servants that you have, or any public servants, you can actually have very generous superannuation schemes that might let you actually claim your benefits earlier than what you were thinking. So that can definitely help. So what we've got now is also then, how does the redundancy impact your superannuation and insurance? So with the superannuation, as you're working, your employer is paying money into your super. Once you stop working, money won't be going into there. And with insurances, there has been new legislation that has come out this year that if you, for an extended period, don't have money going into your super, your insurance actually may lapse. So it's important that you do talk to your super fund. If you do have, you might have life insurance, income protection, and then you might actually also want to look at, well, how do your insurance premiums, how are they impacting your super balance as well? If you do go back to work after a short period, it can be worth looking at, well, do you top up your super with a bit of extra money out of your pay? So with that, while you were out of the workforce, you'll actually find that if it was an extended period, when you get to retirement, by not having that money paid into your super, you may actually lose out on a significant amount of retirement assets. So that's why we encourage you to, if you can, to top up your super and try to catch up those payments that you missed out on receiving. The other part is then, well, how do you re-enter the workforce? A lot of people, I know here in Canberra, that people that work, say, as a public servant, they might then go back and work for their old employer as a contractor, or people then start thinking about being self-employed as well. Or you might find a job somewhere else. If you're self-employed or a contractor, you want to make sure that you do actually make those minimum repayments. You may not be required to, but paying that money into the super, if you don't pay it, it may actually hurt you in retirement. So at the moment, the minimum superannuation guarantee rate is 9.5% of your salary. So we do encourage you to try and make those repayments into there. And then you might actually, where we talked about early retirement, you might be able to, if you have received a lump sum of money, you might choose to go back to work just as on a part-time basis. So that then can also provide you with a bit of a transition into retirement. Find out if you actually like being at home or you're just not ready to retire. So now we've looked at superannuation. One thing that we do need to actually, if we go back a couple of slides, there was one of the important things that we do want to look at is how investing for income and growth. One thing that we do find quite often with people is when you get a redundancy, the biggest fear is not having an income stream. So you might find work quickly, which helps with that, and then you're able to save the redundancy. But if you're not able to find work quickly, you might actually need to use some of that money, and you can have it in a bank account, and you might actually be really good at budgeting and saving, so that you've just got it sitting there and you're just taking out what you need. You know what you're earning each pay, so you can just easily budget and you know what that side of it is. However, what you can actually sometimes do is if you don't have as much control over your money, you could look at maybe starting, whether you start a separate bank account, you might also be able to start an investment portfolio. There are products and facilities available that will allow you to put the money into something and it'll pay you, or might pay you weekly, fortnightly, monthly income. So it'll still feel like you're actually getting paid, but it stops the risk of, oh wait, I know I've got all of this money in the bank account, that looks pretty good on the shelf, whether it's a new TV, that might be, I would like that, I probably don't need it, but I've got the money. It takes away that risk. And then if you do find the work quickly, you may not actually need to take the money out of the portfolio to fund it. So you could save it for retirement. You could whether you put it into superannuation, or there are other facilities that you can have it in your own name. So everybody's situation is different. So there are different ways, different ways of saving. So definitely have a think about, well, what would that mean for you and what you would want the money to do for you. And then, as we said, we're thinking of retiring, and can you access your super, or should you access your super? Comes back into it. So as we said, boost your retirement savings. In here, what it is also important to think about is where we're sort of talking about investing for income and growth, comes back again to that superannuation. A lot of people have sort of thought, well, they've either taken advantage of taking that $10,000 out of their super, or you might be thinking about it as well. So there's pros and cons to that, but there are also, you need to think about how will that affect you in the future. If, say, somebody was to return to work and keep working for sort of 30 to 40 years, we've done the numbers, and if you took $10,000 out of your super, over that time frame, you could actually lose up to sort of $150,000 worth of retirement savings. So that has a pretty big impact on your retirement assets. So then we'd also encourage you to keep putting money in. It might mean that you use the redundancy to top up your super, and then it can be invested. You can invest it pretty well with your super how you like. So there are plenty of options out there. So in summary, as we said, we break it down. There are those four areas. So think about what money you need to live on and how you go about meeting those. Making sure you're taking care of your mortgage, and talk to your bank if you need to help. And then superannuation obviously is impacted in most situations. And then also with the potential for investing. So definitely have a think about what you want to do and what best suits you for that. Excellent. So thanks for that. So I'll pass back over to Ross now. So he'll be able to run through a few things for you.
Thanks very much, Chris and Lindsay. So as you can see through both of their parts, there is a lot to consider when you are being faced with the redundancy, right through the uncertainties to working out what you're entitled to, how it's calculated, and as well planning ahead. As Chris mentioned, redundancy do impact a lot of aspects, right from your personal objectives, needs, investing, debt, superannuation, and income streams. So it's also an interesting time, as you might be able to use it to work out how to better your personal financial circumstances in these times. Now, for those of you who are unable to stay with us for Q&A, we will be sending out a link to the recorded webinar and a summary of the questions and answers that we will be responding to. If you did need to get in touch with us, we are located around the country, so we're not too hard to get a hold of. Please, I urge you to contact us through our online contact form. If you have any issues accessing the link, please let us know and we'll be able to get in contact with you. So we've had a few questions come through. I'll just give it another minute or so. So if you did have any questions you'd like to ask, now's your time to type some in. Just a few more moments. Alrighty, so I'll start off with the first one. People have taken money out of their super. Would this be a reasonable idea if I was made redundant? So I have a bit of extra money. Now, could I give that one to you, Chris?
Yeah, definitely. So it sort of touches on where I sort of mentioned before about people have had that option to take the money out. So what you really need to think about is what would be the reason that you would need to take that out of super? Is it there because you may have only been with your employer for a short time, so you're not getting much of a redundancy payment and you do need it to help? Or is it just that you're taking it out to give yourself a bit of a buffer? The key thing that when people have asked us about taking it out is if you are doing, try and take the time when you do return to work to top that super back up. So it's not that it's a right or wrong answer to take it out, it's about what you do afterwards. So if you, as I said, if you have an extended time, it makes a fairly significant impact on your redundancy assets. So actually try and top it back up through maybe some salary sacrifice, or you might just have some spare money if you're saving again. So as I said, not a right or wrong answer to take it out, but just make sure you catch it up if you do take it out.
Thanks very much, Chris. Now, I do have another one that's come through. Might give this one to Lindsay. You mentioned the pension age. What if you get offered a redundancy after age 65?
Thanks, Russell. So I just saw another question come in which is similar on the preservation age. So I might answer both of these at the same time. So with all of these redundancy payments, the government has just extended the period, age 65 is now age 67 for the retirement age. For the redundancy payments in particular, the tax treatment is concessional if you're over the age 65. So that's sort of one issue. But preservation age is a different one. I think this year, preservation age in the 2020-21 year is age 58. So if you were under preservation age, then the taxes are higher. You don't receive as generous a treatment. So reaching preservation age, I know it sounds curious, but if you are having a birthday in the next month and you were the lucky one turning 58, it may pay you to try and negotiate with the employer to receive the payment after preservation age. So yeah, reaching preservation age, that's where from those various tables, and we'll send you the slides, where you get that concessional tax treatment. Yeah, so for all the youngsters, you suffer a little bit more tax. Reaching preservation age, you have lower taxes. So over to you, Ross.
Thanks, Lindsay. Chris, I'm not great with money in my bank account. I will spend it. How can I make sure I don't spend my money too quickly?
That's the definitely a question for all of us. Quite often, if we've got money sitting in the bank account, we will just spend it. So what you can look at is separating the redundancy money maybe from your normal spending account. So it might be that you've got an extra bank account that you just organise a regular transfer. So again, as I mentioned earlier, it makes it feel like you've still got some extra money or a salary coming in. The other option is to maybe try and extend the time that you can use that money to receive an income, is you can actually set up facilities where you put the money into a product or a facility, as I call it, and then it will actually pay you regular payments. So you can say, well, if you're getting $1,000 a week of pay, then you can actually set it up that the same day that you're getting paid, you can have money paid into your bank account. And it doesn't really feel like things change too much from an income perspective. Then that's also taking it away from just having ready access. You can't go to the shops and put it on the card, and then you end up spending a lot of it, and you look in a couple of months' time, and all the money's gone, and then you're in a bit of financial strife. So the key thing is separate the money from your normal spending account, and there's lots of different ways you can do it. So if you did want to look into the different ways, definitely fill in that online contact form and let us know. And one of us, somebody from around the country, depending on where you are, will get in touch with you. Thanks for that, Ross.
Thanks, Chris. Lindsay, what is the preservation age now, and is this the same as the pension age?
I think I sort of answered that one, Ross. Yeah, so the preservation age this year, just to reiterate, I think it's 58 this year. Just to bear with me, everyone born between 1960 and 1965, steadily your preservation age is moving up. I was born a little bit before that, so my preservation age was 55, but all of those this year it's moved up to 58. Then for the next couple of years, you'll need to reach 59, and then by obviously 2025, all of those will need to be age 60, to meet their preservation age. That has a general other implication as well, accessing super in general, whether you've retired or changed jobs. So preservation age is important for access to super reasons, but it is as per the tax treatment. If you're under preservation age versus over preservation age, it'll be, the lower taxes will apply. Ross, if I may, I can see another one here. If redeployment or redundancy is an option, does a decision to not accept a new position with the same employer affect the redundancy entitlements? Yes, the caution here, the employer needs to follow the procedures, either Fair Work or if you look at the tax office. Really, an employer technically can't be offering you another position and offer you redundancy at the same time. So get specific advice, because that may make the redundancy and the tax treatment void. So just be mindful of that. Although we have seen, particularly where some individuals may, after a month or so, seek out a contract with the same employer. But I think specifically the question, just watch out for that one where you may think, oh, look, I'll just immediately get a job with the employer. So big caution there, and get the advice. So it could void that redundancy payment.
Thank you, Lindsay.
Thanks. Ross, I've just also seen something come in via email. So the question there, if I'm getting 1 year's salary as a redundancy payment, is my employer obligated to pay 1 year's super into my fund? The quick answer to that is no, they're not. They don't need to pay superannuation guarantee on redundancy payments. But if you did want to, then you could work out, well, you look at, well, what's 9.5% of the redundancy payment, and you could actually pay that into your super. So that might help top up the lost super that you would have received if you weren't working. But obviously, this all comes down to personal circumstance and personal situation. It might be cash flow that stops you doing it. So before you do make those decisions, definitely encourage you to talk to somebody about doing it.
Thank you, Chris. And we just have one last one that's come through. Am I entitled to any Centrelink benefits once being made redundant?
Yeah, I'll take on that one. Centrelink, so if there are, I suppose, unemployment benefits, so there's job seeker payments that you can get. What comes down to it, if you've been paid out your redundancy and your leave, then there will be what they call a maintenance period, where if, say, you've received a payment that's normally worth 3 months of your pay, then you may actually have to wait 3 months before you could get any Centrelink benefits. And then also, whether you're eligible or not, there are means tests. So there's an assets test, and there can be an income test in there as well. So again, it just depends on other things. It's not as simple as, well, I've been made redundant, can I now get the job seeker payments? And so you may actually have to wait for a little bit and look at what else you've got. So if you've got an investment property, they don't take into account your home. And if you're under age pension age and you're keeping your money, your super investments in the accumulation part of it, so that's where all your money gets paid into, then that's not counted in your assets either. But as I said, everybody's situation is different. And the amount that you get paid will vary depending on your employer.
Thanks very much for that, Chris. So I think that now sums up our webinar for today. We hope that you were able to take something away from it. If you did need to get in contact with us, as Chris mentioned, please complete the online contact form. We are nearby, just a click away, and someone will endeavour to get in touch with you soon. From us, in the next 2 days, we'll send out some further materials. You should be receiving the webinar slides and our Q&A summary. So thank you very much for attending, and we look forward to seeing you for another webinar.